Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill. Later, I'll be speaking with Peter Feinberg. Peter Feinberg is an attorney and an expert at corporate formation and intellectual property transactions. Does that sound dry? Well, if you want to make money as a startup, especially a tech startup that's scalable, that can make lots of money, you better get somebody who can explain to you about corporate formation, explain to you about intellectual property transactions, who can help you through the legal mechanics that take you from idea to value realization, but maybe even more so, to teach you what issues to look out for, what questions to ask, what things to worry about. There are moments when you're not actively building the value part of your business. Anyway, that's a little bit later. First, let's talk about blockchain. A lot of stuff in the news about blockchain. And I must confess, as much as I read about it, I haven't been able to put my hands on it directly. I am not a tech person myself, and I don't quite understand it fully. I talked about it on an earlier program of ours, perhaps a year ago, because in May of last year, there were a lot of news reports about potential use of blockchain by the country of Honduras. A company called Factum Inc., Factum Incorporated, was proposing to reform the land registry in Honduras to make it more transparent, to make it more reliable in places like Honduras, in Latin America, in Africa, and other places that are very much less developed and where political control has been in the hands of a few families of the military or dictatorship, but not an egalitarian society, not a society of broad ownership. The ownership of land has been a very centralized and, let's face it, corrupt affair. Frustrates the ability of ordinary people to build businesses, to own real property and purchase and sell real property in a secure way, and also to pledge real property to borrow money and build businesses, lives, power, influence, and be entrepreneurs and be successful and so on. Well, I spoke in glowing terms about the promise of a technology which blockchain appears to be, which can deliver those things. Unfortunately, I must report that at this point, Factum Incorporated is reporting that there are political roadblocks to the realization of the reform of land records in Honduras in this way, which reminds me, one of my favorite movies, The In-Laws, the original In-Laws from 1979 with Peter Falk and Alan Arkin, in which Peter Falk is explaining to the disbelieving Alan Arkin about how he on a mission in Central America and giant tsetse flies carrying off children into the mountains, and how he lost the photographs of that. Actually, they were lost because of, quote, red tape in the bush, end quote, which is one of the funny lines in the movie. Anyway, I think there's red tape in the bush when it comes to blockchain, Honduras, the land register, and Factum Incorporated. But more on blockchain. There's a very good website called findlaw.com, findlaw, all one word.com. Yeah, it's for lawyers, but it's written also for general audiences. Thomson Reuters Business, findlaw.com. On February 5, 2016, findlaw.com featured an article called How Will Blockchain Technology Change the Practice of Law, written by Casey Sullivan. I tell you all that to help you find that article, not because how blockchain is going to change the practice of law is so important to everyone, but because there's a cute little video produced by the Greenhouse Group Labs, which attempts to convey what blockchain is. It's only about 4 minutes long. And animated characters tell each other their favorite colors, which is information. And the video portrays how information is connected to other information in the blockchain, and how all the parties to the blockchain can view all that information with total transparency, and how it is extremely difficult to change information on the blockchain once it's there. It's not like a centralized, land registry in Honduras, for example, where you just need to get one person to change information. No. On the blockchain, you must get large numbers of people to change it, which means it's impossible to change. So there's an incorruptibility and transparency to blockchain, which is why I think Factum Inc. was trying to do what it was doing, but also why JPM, IBM, and Goldman Sachs are investing large amounts of money and talent into developing derivations of blockchain for more financial applications, away from the Bitcoin application to which blockchain is associated, because the two grew up together, Bitcoin and blockchain. The article quotes two lawyers from the highly respected firm of Holland and Knight, who give you a legalistic definition of blockchain. And I'll just read it to compare it to the delightful little animated version, which you will see if you find the FindLaw article again, February 5, 2016. FindLaw, written by Casey Sullivan, How Will Blockchain Technology Change the Practice of Law? Well, here's the definition. A decentralized digital ledger that combines digital cryptography algorithms with a system of decentralized computing power that redundantly verifies transactions which are recorded on a public digital ledger available to the world. Or, in brief, info that's connected to other information, total transparency that is very hard to change. Let us shift gears from blockchain to business distress. I read an article in the Wall Street Journal which made me feel good. In my other life, I'm a commercial restructuring attorney, and it made me feel good because ArcelorMittal, the world's largest steel company, is taking steps to deal with its distress. The article was written February 6 and 7, or published February 6 and 7 in the Wall Street Journal, called Arcelor Grapples with Glut. Steel industry is in very tough conditions because there's lower demand, including lower demand from China, and more supply, including more supply from China. And it's very tough to make a living selling steel. ArcelorMittal lost $6.7 billion in the fourth quarter of 2015. One quarter, they lost $6.7 billion, $8 billion for the year of 2015. That's a lot of lost ground to make up. Well, the average price of steel declined by 23% in 2015. Price of iron ore declined by 43% in 2015. So what's ArcelorMittal doing about it? Well, they're doing stuff about it. As a commercial bankruptcy practitioner representing principally creditors in recent years, I find that my clients are having interactions with companies that didn't do anything about it. They engaged in denial and found themselves in bankruptcy. Of course, stress of the steel industry might, like the stress in the oil industry, result in failure of many companies just because of the overall distress. But individual companies can deal with distress if they deal with it early, and Arcelor is trying to do that. They have $15.7 billion in debt, and they're taking steps to cut that down to prevent that from crimping their liquidity in the future. And how are they doing that? Well, they're selling certain assets, not the crown jewels, not everything, but they're selling, for example, a Spanish manufacturer of bumpers, chassis, pedal boxes, other car parts. They're going to use that money to pay down some of that debt. And Arcelor is issuing $3 billion in shares, 1/3 of which, by the way, are going to be purchased by the company, by the family, the Mittal family, which owns about 39% of the company. So a cash injection at this point, a sale of assets carefully at this point, and you have a strategy, which is not the same thing as denial, for dealing with distress. Now, why am I emphasizing this? Because there are ways to make money from distress. Buying distressed assets is another form of alternative assets, which is, generally speaking, the asset class with which accredited investor markets is concerned, if not primarily, largely. Well, among the family of websites in the financial boys world are 3 bankruptcy websites that can teach ordinary folks, ordinary intelligent folks, non-specialists, everything they would like to know about bankruptcy and about dealing with distressed businesses. They are Commercial Bankruptcy Alternatives, Commercial Bankruptcy Litigation, and Commercial Bankruptcy Investor. And I would like to point you to a particular group of articles on commercial bankruptcy litigation. There have been 7 installments, and there will be more under the general rubric of dealing with distress for fun and profit. It takes you step by step through the distress scenario and the bankruptcy world. These articles are written by 2 true eminences, Jonathan P. Friedland and George W. Cuny. Friedland is an eminent practitioner here in Chicago of restructuring law and has written many books and hundreds of articles. Similarly, George Cuny has written many books, maybe a few more books than Friedland, and also dozens, hundreds of articles. They are co-writing little 1,500-word essays written in plain English to explain this bankruptcy stuff that journalists fling around with, well, not the greatest amount of precision, and which can help guide you should you be tempted to invest in a hedge fund or a private equity fund that has distressed asset strategies involved. These articles also can help people who run companies or who are working for echelons of companies to feel their way toward recognizing when strategic rethinking is necessary to address either distress that's with us or distress that's coming, perhaps as constructively as I hope ArcelorMittal is addressing theirs. But now on to brighter, more optimistic things perhaps, with our guest. A person might well invest in an early stage private company and look toward a favorable exit, by which I mean lots of cash at some point. For many of the rest of us, such a process might remind us of the infamous Underpants Gnomes episode of South Park. Boys one night were confronted by Underpants Gnomes walking off with their ill-gotten gain. They snag one and ask the Underpants Gnome why they're taking away the underpants. Response, and I quote, "Step 1, collect underpants. Step 2, profit." Well, to help us begin to understand step 2 better than the Underpants Gnomes did, we have with us today Peter Feinberg. Peter Feinberg practices law at Hoge Fenton in its San Jose, California office. Peter is expert in corporate formation, reorganization and governance, finance and venture capital transactions, securities law compliance, domestic and global mergers and acquisitions, and domestic and global business and intellectual property transactions. Peter was a partner at Thelen, Reid and Priest and at Ferrari, Olson, Ottoboni, and Bebb, and has also served as in-house counsel to NetApp and Clorox. Early in his career, Peter was Deputy Attorney General for the state of California. Thank you, Peter Feinberg, for being with us today to explain step 2.
Thank you, Chris.
All right, well, Mr. Feinberg is an attorney. I, too, am an attorney. And I guess at this point we should be making disclaimers, right, Peter?
Absolutely.
You can't rely on anything we say. Well, what I mean to say is there is no legal advice being given here. You are not our client. No sort of attorney-client relationship. We are speaking on general matters. If you have any particular matters, you should seek the one-on-one attention of a lawyer. You might even contact one of us to find such a lawyer, but that's where it stands. Is that about right, Peter?
That's perfectly right. I think that we should view this as kind of a first step to stimulate thoughts in people's minds on some of these topics, and as an initial step for them to research further on topics that we discuss that are of interest to them.
Excellently put. Okay. So before we even think about becoming that person awaiting a big payday with an exit from an early stage private company, that person should be thinking about how such an investment makes sense in that person's resources and overall investment plan. Isn't that correct, Peter?
That's exactly right, Chris. And I'm going to distinguish for purposes of this question. There are a number of different sorts of people who we could be talking about. We could be talking about an employee who has stock options. We could be talking about a venture capitalist, which is a company generally which is professionally making these investments in very large amounts. Those are sort of on the opposite ends of the spectrum, with the employee being the earliest and the venture capitalist being the latest of the private stage process. In between, you typically have what are known as friends and family on the one hand and angel investors on the other. And I'm going to focus most of my answers in our conversation today on those folks. And you're exactly correct that these are people who are not, for the most part, doing this sort of thing professionally. They may be people who know the business folks from a long-term personal or professional relationship, or they may be people who have made money in different other regards and are now either on their own or through a group of people making sort of small to medium-sized investments. But it can't be emphasized too much that most private companies do not succeed, and this is a highly speculative part, should be a highly speculative part of one's finances. Before, I think Jim Cramer patented the phrase, I would have called it mad money. You may or may not know that much about what's going on with these companies. They're certainly not companies about which there are things like 10Ks and 10Qs and annual reports out there. This should be a small part of your resources and nothing that you're really counting on for the large amounts of expenses you have or retirement or anything else along those lines.
You might end up with magic beans, but you might well end up with nothing.
Correct. Even worse than magic beans.
All right, well, for the non-professional, corporate form is something that might be vaguely understood. Often, companies start out as an LLC, maybe even an LLP, but these things are creatures of state law. Which state should it be? Should it be a Delaware C corporation? How should an early stage investor think of this question?
I think a lot of this depends on where the company sees itself going over the longer haul. I know that we're going to talk a little bit more about venture capital and even IPOs as we go forward on this. But I think that there is a hope among many companies that they will get professional venture capital investment and be able to go public. And I think it's important early on for companies to honestly assess that, because if you have a chance to speak with venture capitalists in forums or other different places, or speak with investment bankers, they will tell you that the number of companies that they look at versus the number of companies that actually get venture capital funding, or the number of companies that approach an investment banker that actually get public, is very, very small. It may be 1%, maybe 2%, it may be less than 1%. There are costs in terms of the entity you choose and the state you choose, and you need to think about those things carefully when you make an initial decision to do business, with the thought that you can always change later on, but there may be incremental costs involved. Having said that, if a company really does believe that it does have a good chance of getting venture capital funding and going public later on, the form that venture capitalists and investment bankers are clearly the most comfortable with is a Delaware C corporation, exactly as you suggested. I'm not sure how much our viewers are aware of this, but Delaware is sort of the Switzerland of North America. They have developed an extensive body of corporate law, so it's both much more predictable on the one hand, but it's also much more management favorable on the other, which leads to, in many instances, a more conducive place for companies to be incorporated. And a C corporation, you do not face the kinds of limits on number of shareholders, non-resident aliens investing, investors who are non-individuals, such as corporations or partnerships investing, that those forms would face. So C corporations give you much more flexibility in terms of how your investment and how the company's capitalization structure is set up. Having said all of that, let me then backtrack briefly and say that for the 99.8% of companies that are not going to get venture capital money and are not going to go public, they really need to think hard about whether that is what they want. C corporations do face double taxation as opposed to pass-through entities such as S corporations, LLCs, or partnerships. And incorporating your business in a state where you are not primarily doing business may well lead to essentially two different sets of bookkeeping where you're paying taxes and different other kinds of fees, not only in Delaware, but in the state where you were primarily doing business. So the answer is that there isn't really a simple answer, but for the people who are professionals who are looking to invest, if you think that's the track you're going into, and that it's more important to do that than perhaps to be able to tax efficiently distribute profits from the company, then a Delaware C is sort of the easiest fallback.
Well, I guess one could say that at the early stage, it might be best just to keep it simple, and once your cash flowing and growing, to seriously consider when to make a switch if you think you're going to be VC material. Is that a fair?
That's one way to do it. The flip side of it would be that you could see if you start making a lot of money early, and if you do start making a lot of money early, then switch just before the investors come in to a C Corp at that point. I do want to caution folks that I am not a tax attorney, and there may be tax consequences involved in changing entity forms, and it is something that they should consult with their CPAs about.
Absolutely. All right, well, aside from corporate form, let's say you do have a early stage company that's chugging along, generating revenue, growing. What sorts of questions now should an investor be asking, again, outside of corporate form?
This is a great question, and there are a lot of different parts to this. Certainly, the more information you can get about a company you're going to invest in, the better. And I don't want to go into numbing detail at this point, but companies that are dealing with unaccredited investors will be statutorily compelled, if they are raising a large enough amount of money, over $1 million, to produce something called a private placement memorandum, which is essentially like a prospectus light, almost like what a company is producing when it is going public. Companies that are just dealing with accredited investors or dealing with smaller sums of money usually don't want to incur the time and expense to prepare this, but they should at least try to give investors who are putting in a six-figure sum of money something that could go under the heading of an offering circular or something else along those lines. Among the things that you would like to see in that document would be a good description of the company. Some discussion, you were talking about a company which is growing revenues, about when the company may become profitable, because revenues ultimately are not going to help a whole lot if it's not getting down to the bottom line. How the funds which they are picking up by way of the investment are going to be used as sources and uses of proceeds. What are the risk factors of this company? Is this a highly regulated environment that they're operating in? Is there a lot of competition in the area? Is the IP protectable? These are all kinds of questions that you want to look at rather than seeing a generic list of risk factors. And again, for our listeners who may be investors in public companies, they may be familiar with these kinds of discussions from looking at the annual reports that they get from the companies that they're investing in. It's very important to look at the character of the stock that you're going to be receiving. Typically, for friends and family and angel investors, they are going to get common stock, which is going to be the same kind of stock that the employees of the company get. But in some instances, they will get a preferred stock, which will be valued at a higher price, but may carry a dividend, will probably have a liquidation preference, could conceivably even have some sort of redemption rights or preemptive rights. They may get board representation as part of their shares. All of this should be stuff that is disclosed and in agreements which they receive as part of the investment process. And finally, and I know we're going to talk more about this as we go on further, they need to talk with the people who are in charge of the company at that point about what is the exit strategy. We talked a little bit before about how difficult it is to do an IPO, because the IPO market can really slam shut quite hard in bad economic circumstances, so that most companies that are reasonably successful are exiting by way of a merger and acquisition transaction. But it's important to get some sense, subject to the fact that things are always subject to change, about how long the company thinks it's going to be operating before it thinks it's going to get to that point. When are you going to get liquidity on this? There are going to be all kinds of securities laws which are going to restrict your right to transfer these shares, but even above and beyond that, the secondary market for shares of privately held companies, unless they are the absolute most well-known of privately held companies like Uber, tends to be extraordinarily limited. So investors need to hear from the management of the company how it thinks it could get to a point where it could have a liquidity event.
A lot of looking before you leap.
Absolutely.
So let's keep it a little simple on another issue, an issue that makes my eyes glaze over because I'm not an intellectual property. But let's assume you have three founders, three people, Larry, Curly, and Moe, of course, are their names. And they each had roles in the intellectual property that is the likely value source for the company. Things could happen. Larry could leave, Moe could leave. How does this get sorted out? Does the IP need to be licensed? Licensed to what? To the company? Can these issues lay dormant only to rear up at some inconvenient time? How do we deal with all that?
These are all good questions. The easiest answer here, the easiest and best answer is that one of the things that the corporate lawyer for the company should do initially when these three folks in your hypothetical come into his or her office is to make sure that as part of the formation process, these people assign their intellectual property to the company so that the company essentially ends up either owning it or having some sort of a license to it. Now, it's possible that they may develop some sort of intellectual property that may have uses outside of the company's core mission. So maybe they get back a non-exclusive license either sectorally or geographically or something to that effect. But the broader the license the company has to these intellectual property rights, the easier it will be to attract investors. And investors need to look at this. I mean, they need to figure out where the company is on this stuff. Ideally, the company will have already made filings for these sorts of things so that if, for example, what has been developed is patentable, if you can actually get the patent on it. It has been issued at that point, so that not only has the intellectual property been assigned to the company, but the company's gone out and applied for the patent and received the patent. But at an absolute minimum, they need to have assigned their rights in the intellectual property to the company, or at least a chunk of it, so that the company will have what it needs to go forward. And I would add that when the founders start the company, when they get their shares, part of that process in a stock purchase agreement should include that they have all of the rights necessary with the intellectual property, so that if there is some infringement going forward, the company will have rights against them, rather than the company sort of being left high and dry if a problem arises. Did I answer all your questions on that?
Probably not, but this is a serious matter. I think we've established some of the most promising companies, that is, the ones that promise the most outsized rewards, those that are the most scalable, would be predominantly tech companies, right, which would take advantage of the internet, take advantage of the internet market, and the IP issue would be central to the company and must be addressed appropriately at a very early stage. Am I speaking truth?
That's exactly right. Well, I think you always want to find out with your client what your client's secret sauce is. The IP issues could be a very, very soft sort of IP, like a logo or colors or different kinds of things that don't necessarily need a triple PhD in engineering from MIT and Caltech to figure out. But it's what's going to distinguish you, because if basically the only thing that is distinguishing you is you're 5 cents cheaper than the guy who's 3 doors down, that's going to be pretty hard to sustain over a long period of time. But there are business models that I've seen in my lifetime, and I'm guessing you're perhaps relatively close to a peer of mine, that don't seem all that distinguishable, that have been fabulously successful, like, for example, Starbucks. I think that if you had told me 25 years ago that a company was going to generate a market cap of, $100 billion, wherever they are at this point, just by kind of making coffee with nice cups and comfortable chairs, probably would have said you were crazy. But God bless them, they've done a great job with it.
I should mention that we've had as guests on this show people from entities which specialize in helping promising startups meet these challenges, not necessarily the legal challenges, but all of their due diligence challenges. And I'll just mention a couple of them. Propel X is on the West Coast. That's PROPEL with parentheses around an X. And CrowdCheck. They're both devoted to this sort of work, and they're among many others. This isn't an endorsement. I just wanted to reassure the viewers that it's not just you and the attorneys. You can get help from others as well.
I think that's a really great point. I think that this process can be broken into any number of pieces, and I think that one of the things that is really important as you go forward with this is not only the quality of the people you work with, but who they're connected to, because certainly there are ins that you can have through, your law firm or your accounting firm that will help you with investment bankers, or that will help you with folks who can help you with your IP or other different sorts of things. And it's really, you should be thinking of it as kind of hiring an ecosystem. And where are you at this point? What are the things that you need, and who are the people who has the expertise that you don't have to get you to that point, whether they're employees or whether they're outside consultants?
A less obvious question, I think, because everybody knows IP is mysterious and important. But let's say you are friends and family, and the management is the founders, and they founded the thing. They're cooking along. They have an entrepreneur's sort of focus and intensity and relentlessness. Is it possible that even with all of that management might become an issue in a few years? And what sorts of issues might arise? And then what do you do about it?
Yeah, this is a great question, and the answer is I'm not sure it is a legal question per se, but it is a key question with startups, because sometimes people who have the best experience in developing the product aren't necessarily the best ones to run a company, and then sometimes the people who are in there at the early stages of running don't necessarily have the managerial skills to get it to the next level. I think in your example, it's very hard for friends or family or even angels to be the one sort of putting the blocks to management and saying, hey, look, you really need to step aside, make yourself chief technology officer or something along those lines, but get a full-time CEO or CFO, because you just don't have the fluency with the numbers, or we can't get you in front of an investment banker for a half $500 million deal or an IPO. I think you just need to look at the company and see how it's developing. And it can be very difficult because the company can be growing very, very fast for a period of time, but can be growing very fast into hitting a brick wall. If you look at public companies, for example, I think a company that has done a spectacular job from a relatively narrow start has been Facebook up to this point in time. I think that they've done a terrific job of acquiring a lot of businesses that were sort of ancillary to their initial mission. This is not investment advice, by the way. I think you had that disclaimer thrown in. But then you look at a company that was sort of in a similar area, Twitter, and I think that they've had a harder time branching out. Obviously, both of those companies got public at very large valuations, and it's probably no secret because Twitter has now had management changes in a way that Facebook has not. But it's very difficult to tell when one is hitting the wall, unfortunately, until one is about a half an inch away from it. This goes back, I think, to an early question that you brought up about what are the kinds of things investors should be asking and looking for. And I think that the background of the people who are running companies is really, really important. Ideally, you have somebody who has successfully been involved at the highest levels with a prior business. But even if you don't have that, to have somebody who has succeeded in sort of a high managerial role elsewhere is important. And I think that there's a big touch and feel component to this. I think that feeling comfortable with management in terms of how they interact with you is key, because if you feel that they don't interact very well with you, then you have to wonder a little bit more about how they're going to deal with their customers, their suppliers, their employees, and other key people to their success as they go forward. So I don't have a precise answer for you on that other than to reinforce the fact that management is incredibly important, and you can have the greatest product in the world, and if you have the wrong management, the company's just not going to get anywhere.
All right, let's turn to a related question, vaguely related, I guess. Professionals throw a term like cap table around and say things like, we don't want to clutter up the cap table. What is a cap table, and how can it be important to the startup for getting more investment or for exiting?
So the cap table is the listing of who owns equity and what the kind of equity is that they own. So we should backtrack a little bit and say that with C corporations, and to a lesser extent, because the statutory framework is a little bit less clear in many places, there can be multiple classes of stock or multiple classes of units or membership interests in the case of an LLC. And typically when you have venture capitalists, and sometimes even when you have angel investors coming in, we talked about this briefly earlier, you can have multiple classes of stock. And what multiple classes of stock can do is sort of disentangle the role of the professional investor who is not necessarily involved with the company on a day-to-day basis versus the employees and the management of the company who are very much involved. They can get their shares issued to them at a lower level, but not have some of the rights, preferences, and privileges which the professional investors may have, such as a liquidation preference, which is to say that if there is a limited amount of money in the company when the company gets bought, they will get paid first, or they may get a dividend while they are waiting for that liquidity event. They may be insured board representation. There are all sorts of different things that may come along with that. But it does get more and more complicated. And typically the companies that are going public, at least in the technology area at this point, do ultimately end up having somewhat more complicated cap tables. But it's better to keep your number of investors smaller rather than larger toward the beginning. You have securities rules that can be involved. You can have people who are involved with the company who wander away from the company and it's hard to contact them and their legal status becomes sort of questionable. There are all sorts of different issues that can arise by having a lot of investors and a lot of classes of stock. So the simpler it can be kept, the better. But once you start dealing with professional investors, particularly venture capitalists, and doing formal rounds of stock offerings, oftentimes, alas, your cap table can only be so simple at that point.
Well, if there's one quotation that of Jean-Paul Sartre that people know, it is from one of his characters in one of his plays, and the quote is, "Hell is other people." You'll remember that, Peter. That's from the play No Exit, which in French is huis clos. Aren't you impressed that I knew that, Peter?
Almost as impressed as quoting South Park.
You
are truly a man of parts, Chris.
Thank you. Thank you very much. I've been wanting to hear that through all the last 65 episodes. You finally said it. So I think you were already expounding on the theme I wish to introduce, which is that other investors may be hell, or they may not be hell, but it can certainly raise complications because each time a liquidation preference is handed out, or I should say bargained for by a new set of investors, it does something to other investors' positions, to the point where some of these preferred shares might start looking like loans, and now you're almost in a capital stack situation where you'll see nothing until these guys get paid in full, etc. Could you comment a little on that?
I think that's an excellent point, an excellent question. And I think, again, it is as important as I can stress it, that there be a sense when you're putting money into a company to get an idea of what the longer-term plan is, and then to figure out what your rights are, because you can find yourself getting significantly stepped on in these instances where someone else comes in and there is a liquidation preference and they are guaranteed to get a certain amount out before anybody else gets anything out. And the question is, when you buy in, what are you getting at that point, and what are going to be your rights in terms of the future? There's something called preemptive rights, which would permit you to, in its simplest form, retain your relative position on a go-forward basis. And companies are relatively reluctant to give those out because it does tie the company's hands a little bit as it goes forward, but it is something that should be thought about by investors at all stages that are buying into companies. You also need to think about what your representation is in regard to the company's governance, whether you'll have a seat at the board, and whether you'll have some say in terms of what the company does when it goes forward. You need to think about what your liquidity needs are compared to what other investors are, because other investors may be much more willing to sit for a longer period of time without getting liquidity, or if they're preferred investors, they may be getting partial liquidity through things like dividends. Alternatively, they may want to get out sooner than you want to get out, and you may feel that you want to get 10x from this investment. They may be very happy getting 2 or 3x. So it really is important to kind of know who you're going to bed with on these things, because it may really affect your timing for getting anything out, or even if you're able to get something out at some point. So very important to speak with the company and to have some sense of what your rights are at the time you're buying in and what your rights will be going forward.
Well, then, speaking of liquidity, and this is the penultimate question, we'll finish with M&A or IPO. But speaking of liquidity, before the M&A or IPO event, you want to get out. Is there a secondary market? You mentioned this earlier, but I just thought I'd ask this question right before we got to the ultimate question. Is there a secondary market and an option possibly for an investor to get out?
This is a very timely question, because I was just engaged by someone yesterday who has started one of these secondary market exchanges for privately held companies. And this is a booming area, which in fact the public exchanges have gotten very interested in, because there are more and more people in these investing pools. A lot of these larger companies like Uber are doing multiple rounds of offerings and getting to the point where they have large numbers of investors. And people are finding, going back to an earlier question of yours, Chris, their wealth getting very, very concentrated in an illiquid asset. So springing up the beauty of capitalism to meet this need of people who have liquidity, there are these third-party exchanges which will put sellers of the stock, whether they are employees or angels or venture capitalists, in touch with other buyers. Now, there are all sorts of restrictions in regard to buying and selling unregistered shares or shares of companies which are non-public companies. And because of that fact, and because of the difficulty in coupling buyers and sellers, this is not going to be something like TD Ameritrade or Interactive Brokers or E-Trade, where you're paying $7.95 for a trade. This is an instance where there is going to be a significant difference between the bid and the ask on the stock, both in terms of what the buyer is willing to put up with, because the buyer is going to have these liquidity constraints himself, herself, itself, and because of risks in regard to securities laws and other different sorts of things. The other point that I think really needs to be brought up on this is that it is really, for the most part, in terms of your buyers, very sophisticated, very high wealth, either individuals or funds doing this sort of thing. And the companies that they are interested in, they don't want to hold for forever. So they're the companies for which there is some public information on file, companies that look like they have a good likelihood of some sort of liquidity event in the near-term future, whether it's an M&A transaction or an IPO. But, you know, if you have a restaurant that has suddenly opened up 3 different branches and they've given their manager some stock, the last thing in the world I want to do is, if that manager's listening in on this call, give him or her the sense that, you know, that their allotment of stock in this small restaurant is something that they're going to be able to get in touch with Goldman Sachs or NASDAQ or even one of these new startup exchanges and find a buyer for it, because that's probably just not going to be the case. You're really talking about companies that people are christening the unicorns. These are the billion-dollar plus multiple venture capital round privately held companies that are, we were talking before about a 1 or 2% likelihood of going public. These are companies that are significantly greater likelihoods of going public. Still very, very, very risky. Still not like, for the most part, investing in a publicly held company, but companies that are much larger, about which there's much more known, and, you know, which probably do have at least a somewhat better chance of finding a liquidity event than randomly picking a privately held business.
All right, let's finish with the following question, which is probably phrased less helpfully than it could be, but a merger or acquisition on the one hand or an IPO on the second hand, which one's better?
Well, IPOs are, I think that the first point is the difficulty of doing an IPO. I think in a really good year, a couple hundred companies may get public. In a bad year, it may be close to zero. Whereas there is always ongoing merger and acquisition activity. It's just a question of the volume and the price of it. So I think that starting with the thought in mind that you're absolutely going to get your company public is probably a little bit optimistic in the vast majority of scenarios. If you can get your company public, the process of getting your company public is quite time-consuming, quite regulated, and quite expensive. You're probably looking at several $1 million in legal and investment banking fees to get to that point. And you need to look at what your company would look like after you got it public. If you can get your company public and it can look like Facebook or Google, God bless you. I mean, you are a lucky person at that point in time, and you will have an absolutely totally liquid asset that you can dribble out in whatever way you want to dribble it out so that it is as tax advantaged as you want it to be or as it can be. And you will have a great degree of notoriety and fun, ringing the bell for the New York Stock Exchange and being seen on the cover of Forbes magazine and everything else that goes along with that. On the other hand, if you are fortunate enough to get your company public, but you are in a situation where your company remains relatively small, say a sub $1 billion market cap company, and perhaps for some of our less familiar listeners, $1 billion may seem like a large number, but for a public company, it's actually a quite small number. You may struggle to get analyst coverage, and you may have extremely light volume in your stock. You may find that there is a big gap between the bid and the ask when you try to sell your stock. And at the same time, you may have regulatory costs in terms of securities filings and audited financials and other sorts of things, which aren't going to be all that different than the Wells Fargos and Goldman Sachses and Facebooks and General Electrics of this world. So it really can be a mixed blessing in that instance. Mergers and acquisitions are a little bit more of a down-the-middle path. The other point, one last quick point, a downside on an IPO, is typically for founders and early investors in an IPO, they will be required to sign something called a market standoff agreement, which will require them to continue holding their shares after the IPO, usually for a period of 180 days, sometimes even more. Sometimes your shares won't be registered and you'll have to hold them longer. And if you have a truly hot IPO, what can sometimes happen is it will spike up at the offering, but it will settle down significantly afterwards, so that the price you get may be a long way from the best price after the IPO. The merger and acquisition situation is, as I said, tends to be much more available. It is going to depend on how you get paid. As I said, in an IPO, you're going to sell your shares in kind of whatever way you want to sell them, and you will get cash at that point. In a merger or acquisition, you may get cash on the barrelhead. You may take back promissory notes. You may take back stock in the buying company. There are any number of different sorts of possibilities. You may need to stay involved with the company afterwards. There may be a covenant not to compete afterwards. There are other different sorts of things that go along with that. It's a little hard to come up with a generic answer to the question other than to say that it's going to depend a lot on the individual company's circumstances in terms of what will be best in that instance. But when you're in a case where you could have, say, a nine-figure IPO, a nine-figure merger acquisition transaction, or an IPO, that's the proverbial good problem to have to decide.
Right. Well, Peter Feinberg of Hoge Fenton in San Jose, California, thank you very much for coming on the show and so clearly fencing your wisdom.
Thank you so much. It's been a pleasure, Chris, and
yes.
I hope your listeners are leaving with a little more information than they came in with.
Yes, information and wisdom, not legal advice.
Absolutely.
So this has been Accredited Investor Markets Radio, soon to be rebranded, by the way, as Financial Poise Radio. This program is produced by Stephanie Strait. Thank you all for listening. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.